The broader picture still favours a cut in interest rates next week. We are joined by Dominic Lapointe, global macro strategist at Manulife Investment Management. Dominic, thank you very much for joining us. So essentially,
Good morning,
you think the Bank of Canada has the ammunition now to cut?
Well, I think this was the last important data that they needed to make a final decision. If you go back to when the April NPR, what happened since then, we've had decent CPI print in April. You did get a strong NFS, but it was mostly driven by population growth. You've had a miss on retail sales, suggesting that consumption is not too strong. And then this GDP print this morning, which says there's no urgency in the Canadian economy. Things are still holding on fairly okay, but that doesn't mean that it's re-accelerating from here. I think that's the important point when you look at forward-looking indicators. I don't think it's pointing towards a big re-acceleration with those interest rates. And that's why when we look at all the data, we still think that the Bank of Canada will be in a position to cut interest rate next week.
And do you get the feeling they're eager to do that if they can?
Well, of course, I think if they cut interest rates, the main reason why they will do so is because they brought down inflation from record high levels since the 80s to somewhat, depending on what measure you're using, close to target or below the target right now. And so you're doing that on a backdrop of an economy that is slow, very few private hiring at the moment. But as I said, there's nothing collapsing. There's no widespread layoff. If you want to avoid more pain going forward, you cut interest rates. So I think that it's a good position to be in to actually cut rates right now.
Interesting. You mentioned these underlying signs of strength in the economy. Business investment, I mean, that's been a problem in the Canadian economy for quite a few years, but actually rose after 2 quarters of contraction.
Yes, on a quarter-over-quarter basis, you see a little blimp up, right? If you look on a year-over-year basis, they're still falling. But when you actually ask businesses, both small businesses from the CFIB or the Business Outlook survey conducted by the Bank of Canada, their investment intentions are really weak, and that's usually a good forward-looking indicator of what's going to do. So I don't think that this morning's data regarding business investment is the start of a new trend upward given alleviated interest rate. I think business face weak foreign and global demand, and at the same time, they're increasingly going to have to refinance their debt either in public or private market at very elevated interest rates. So I'm still concerned about business investment, despite I'm taking this morning's data as positive.
The household savings rate in Canada hitting 7%. That's the highest in decades, depending how you measure it, if you exclude COVID, etc. We keep hearing Canadian households are strapped by these high inflation rates, but people are managing to suck a fair amount of money away.
You could see it both ways. You could see it as a positive thing. Remember, pre-COVID, a big issue was the fact that the savings rate was really low. We didn't know for how long it would continue. Now, I think this time, when you look at the high savings rate, could be that the highest earners are still doing good, and we know that they still have some excess money from the pandemic to save. At the same time, could also tell you that you are more worried about what's going to happen in the future. If you have a mortgage to renew, if you have to pay a rent that has inflation of 7%, if you're actually worried about your job, which the Bloomberg survey of consumer confidence increasingly says Canadian households are worried about job security, then you might want to save a little bit more right now. So, and that also means that going forward, if you're saving more, you're consuming less.
Broadly speaking, are we headed for a recession, a serious downturn in Canada, or do you think we'll muddle through?
I wouldn't characterize if there's a recession as something severe. When we do the forecast, we still think that we could get 2 quarters of negative GDP growth, if not 3, in the second half of this year. But that would be a very shallow recession if you want to characterize it this way. That also depends on the U.S. So if the U.S. economy carries through and doesn't slow down, it'll bring Canada along like it actually did in 2023. But our team's perspective is that we're seeing nascent sign of a U.S. slowdown. So Canada cannot count on that going forward. Adding on top of that mortgage renewal, as I said, lower consumer confidence, GDP could well contract a little bit. That wouldn't be dramatic, but it's something to be concerned about.
How worried is Tiff Macklem and his colleagues about a bounce in housing if and when they start cutting rates?
I think they would be worried, but they're not going to tell us that they're worried because that's not what they're targeting, right? Their goal is targeting inflation. And actually what would happen if they cut interest rate is that mortgage interest cut, which is still the largest contributor to year-over-year inflation, would fall. However, I think the Bank of Canada is worried about a pickup in housing activity through mortgage debt, which would continue to rise. And in Canada, prices haven't fallen that much, if at all, post-COVID, like we thought with those high interest rates. So if price continue to increase and there's a rebound in housing activity too quick, I think they would be concerned about that. However, you look at the broader picture, I don't think this would prevent them from cutting. I think they would say that, unfortunately, housing is something that they have very little control over.